What's going on, bull runners? Welcome back to the channel. So a recession is now likely this year, the Federal Reserve is saying. So if you thought things couldn't get any worse in the economy than they already are, then welcome to today's episode of how much is my World War III bunker going to add to my mortgage? So here's what you need to know. The Mortgage Bankers Association has reported that the housing environment is becoming so unaffordable in this economy that certain banks actually lost money for each mortgage they financed last year, marking the first time this has happened in history. So this is a big deal. This is also affecting the stock market, the crypto market, that I need to share this information with you. So in 2022, banks lost an average of $301 for every mortgage they financed, which represented a 113% decrease from the previous year's average income of $2,339 per mortgage. Now, this is largely due to the decrease in housing activity as prospective buyers hold back from the market due to high mortgage rates and limited housing supply, all thanks to the Federal Reserve's decision to increase interest rates at the fastest pace in history. And we still have yet to see the largest fallout from what's to come from this. It's going to be very, very bad. And what's going on right now is just the tip of the iceberg. And I have some shocking data to share with you in this video. If you're planning to make money in crypto and then invest that into real estate, that will completely change the game for you. And it's going to drastically shift everything. So watch all the way to the end and make sure to give this video a tippity tapperoo to the like button. You got to sink the putt. Do it for grandma so we could beat the Fed and we could buy her house back, okay? Before the government takes it and her mortgage goes through the roofs. Now, banks and other mortgage companies financed an average of $2.6 billion in loans in 2022, roughly half of the $5 billion figure from 2021. And meanwhile, the cost of financing per loan has gone up drastically. As the decline in business isn't fast enough to make up for the decline in workers, banks and mortgage companies spent an average of $10,624 to finance each home in 2022, which represented a 23% cost increase from the previous year. Now, MBA's Vice President of Industry Analysis, Marina Walsh, she said that the rapid rise in mortgage rates over a relatively short period of time, combined with extremely low housing inventory and affordability challenges, meant that both purchase and refinance volumes absolutely plummeted. And the stellar profits on the previous 2 years dissipated because of the confluence of declining volume, lower revenues, and higher costs per loan, she added. Now, what this means is that experts have predicted a correction in the U.S. housing market, with some expecting housing prices to fall roughly 9% this year. However, others are predicting the market to drop even further. But what could cause the real estate market to crash even further? And should you be concerned if you're looking at buying a home or if you currently have a home right now and you're in a 30-year fixed mortgage? Well, that's a great question. I'm glad you asked. So how would you like to add some recession news to your order today? And would you like to supersize that with some excessive spending with a side of bank failures on top of that? The Federal Reserve has released documents suggesting the fallout from the U.S. banking crisis is likely to push the economy into a recession later this year. And minutes from the March meeting of the Federal Open Market Committee showed that staff economists predicted a recession starting later in 2023 with a recovery following the next 2 years. But what's interesting to note is that we technically went into a recession Q1 and Q2 of 2022 with 2 consecutive quarters of negative GDP. They just changed the definition of what a recession means because they didn't want to admit it because their egos would let them, be wrong. And although Vice Chair for Supervision Michael Barr claimed the banking sector was sound and resilient, and then President of the United States, Joe Biden, he was saying the banking industry is more rock solid than ever before. Which usually when they say that stuff, it's not necessarily true. The staff economists warn that the economy will take a hit. Now, this projection follows the collapse of Silicon Valley Bank and 2 other institutions that have been covered all across the news over the past few weeks, which prompted the creation of the emergency lending facilities to ensure banks' operations effectively, basically bailing out the bank. So I covered this in one of my previous videos. If you subscribe to the channel and you take out a loan on that like button, you can pay that back later with a fixed mortgage. It's called the Bank Term Lending Program, where the Fed added over $300 billion to their balance sheet in just 1 week, erasing over 6+ months of tightening to their balance sheet to bail out SVB Bank. And despite the banking crisis, Federal Open Market Committee officials voted to increase the benchmark borrowing rate by 25 basis points, bringing the Fed funds rate to a target range of 4.75 to 5%, being the highest level since late 2007 and the fastest increase in history, being the 9th consecutive increase in their effective federal funds rate over the past year. Now, several policymakers question whether to hold rates steady as they watch to see how the crisis unfolded, but they agreed to another rate hike because of elevated inflation, the strength of the recent economic data, and their commitment to bringing inflation back down to the target of the 2% range over the long run, and that's their goal. Now, this is important not just for people looking to buy a new home, but it's important for crypto, it's important for stocks, for commodities, and the broader economy that I'll explain in a little bit. But first, a word from our sponsor. So we don't have any sponsors for this video because we fund all of our operations through our online business app, and I want to show you something really cool real quick. Check this out. So if you look right here, it is April 12th, 9:16 p.m. And from April 1st through April 12th in the back office of one of my merchant accounts, done $66,875 right there. So if you want to be able to learn how to earn an extra $200 to $3,000 per day, because we don't accept payments from sponsors, we sponsor ourselves, then you're going to want to click the link in the description below. You can learn how to start and grow a hyper profitable digital business online for free. Little to no money out of pocket, guys. This is awesome. And we have a 100K challenge that we're dropping that you can take if you want to make your first $100,000 online. So go ahead, click that link below. Check it out. Anyways, back to you, Nick. All right, thanks, Nick, for that. So the next FOMC meeting where they will discuss the effective federal funds rate coming up is May 2nd through the 3rd. And markets are currently predicting a 72% chance of one more quarter point rate hike before a policy pivot where the Fed either pauses or cuts rates before the end of the year, according to CME Group data. Now, the housing market is not the only sector affected by the current economic situation, the Fed raising their interest rate. It also has massive implications for the crypto market, specifically if you hold Bitcoin, Ethereum, XRP, any altcoin, because of liquidity and how these markets work. The high interest rates and limited housing supply has caused so many prospective homebuyers to hold back from the market, which in turn has decreased housing activity. And this has a ripple effect on the broader economy, including the crypto market, because as the economy slows down, investors may become more risk adverse and turn to safe haven assets like gold or even government bonds. And with the recent bank runs, investors see crypto as a better solution to holding their income in banks that could potentially fail. Additionally, the current economic situation has also led to a rise in inflation, which can make it more difficult for new home buyers to afford a mortgage. Inflation can cause the cost of goods and services to increase, including the cost of housing. And when we talk about persistent inflation, never necessarily coming back down to their 2% target, this is an ongoing problem that many people are expecting to live with for life, is high inflation and potentially hyperinflation. Now, this can make it more difficult for home buyers to secure a mortgage with a reasonable interest rate, as lenders may be less willing to lend money in a high inflationary environment. So let's say a new home buyer wants to purchase a $300,000 home. You're probably buying a trailer park with that, but let's say you want to buy a new home. Okay? You want to put 20% down payment of roughly $60,000. And then you plan to take out a 30-year fixed mortgage rate at a 4% interest rate. Under these specific conditions, your monthly mortgage payment would be roughly around $1,145. However, if the Federal Reserve keeps increasing their effective federal funds rate, this will likely cause mortgage rates to rise as well. If the new interest rate rises to 5%, the same purchase, right? If you're the home buyer, you would have to pay around $1,288 per month, which is an increase of $143 per month, or $51,480 over the lifetime of the loan. Now, a common guideline is called the home affordability ratio, which determines essentially if you can afford a home. And what this means is the price of the home should not exceed 3 to 4 times your annual income. So if you're making roughly $50,000 per year, you shouldn't be mortgaging a home that costs more than $150,000 to $200,000. Now, good luck doing that in this market. And according to the U.S. Census Bureau and U.S. Department of Housing and Urban Development, the average sale price of houses sold in the United States is $535,800, over $500,000. And the real median household income in the United States is $70,784, meaning the average home affordability ratio in the United States is 7.5 times higher than the average household income, which is a drastic difference. And that's for the average household income, meaning everyone that lives in the house combined, not just one person. The real median personal income in the United States is roughly $37,522, meaning that the average American that wants to afford a house themselves without the help of their husband, their wife, their boyfriend, their girlfriend, or any family members that live with them, then they're looking at spending 14.2 times higher than their annual income. Now, it's important to note that the housing affordability ratio is a general gauge that can help ensure if you can afford your mortgage payments and still live an awesome lifestyle at the same time while covering your other expenses and maintaining a comfortable standard of living, because everyone's financial situation is very, very different and it changes every year, especially for entrepreneurs that are building their own businesses, because one year you might have an amazing year, the next year you might not have such a good year, so you have to average out your years. But it's very apparent that the Fed just destroyed new home buyers that earn close to the average annual income every single year. So as you can see, a higher effective federal funds rate can make it more expensive for new home buyers to finance their homes on 30-year fixed mortgages, which can be a significant financial burden for those who are already struggling to afford a new home in the first place in this unaffordable housing market. So the last time we saw anything like this was during the 2008-2009 market crash and the housing bubble, based on the home affordability ratio being the highest it's ever been. So this housing market crash could be very, very nasty. The main factor that could contribute to an even further housing market crash includes an economic recession or a downturn that the Fed is talking about. Because if the overall economy experiences a recession, downturn, or even a depression, it could lead to a decrease in demand for housing, which is causing prices to drop even further. So if the Fed is predicting a recession later this year, then you gotta be ready for that. Increase in interest rates. Higher interest rates makes it more expensive for people to take out mortgages, reducing demand for homes and potentially causing a market crash even further. So if the Fed doesn't pivot soon, then that could be bad for home loans. Now, overbuilding is another reason. If there's an excess supply of new homes on the market, it could lead to a decrease in demand and ultimately lower prices. Now, we saw this happen during the war for ships. They had a surplus of ships and they couldn't even give the ships away. Now, housing, if they keep building too many houses and then all these things happen all at once, then there's not going to be enough buyers in the market and there's going to be too many sailors trying to offload their homes. And another reason would be natural disasters. Depending on the region that you live in, hurricanes, floods, wildfires, they can cause significant damages to homes, infrastructures. You saw the hurricane that hit Florida just drastically wiped out homeowners and the values of their homes, leading to a decrease in the property value, triggering a market crash over in that area. Now, government policies is one of the major reasons that causes this tip of the iceberg, so to speak, and the momentum to swing. And changes in government policies relating to taxes, mortgage lending, or other factors could have an impact on the housing market and potentially contribute to a market crash. And in one of my previous videos, I played a clip from the head of the Treasury, Janet Yellen, confirming that the Fed is going to add roughly $20 trillion to their debt budget by 2033, and the deficit is going to increase. And this could have a significant effect on the real estate market. Not only could, I think that it will. Now, this will likely lead to an increased inflation, which would cause interest rates to rise even further. Higher interest rates will make it more difficult for home buyers to obtain mortgages at a good rate. And as the prices of properties continue to go up and up and up over the next decade, if they continue to go up and up and up over the next decade, which historically they have, as they print more money, well then as mortgage rates go up, how are you going to be able to afford a home if your income at your job is not increasing at the same time relative to the inflation adjusted minimum wage, as well as increasing the cost of borrowing for home buyers and developers as well too. Now, additionally, if inflation rises too quickly, it would lead to a decrease in demand for homes as people may not be able to afford the higher prices. And finally, if the Fed's actions lead to a recession like they're saying will happen, then the real estate market will drop even further. So that's why it's important for you to have a tactically superior plan rather than just jumping, balls deep into the real estate market right now. What do you need to do? Because if the Fed isn't going to live within their means, if they're not going to default, if they're going to tax the rich more, if you want to become rich and you commented 777 because you're become the first millionaire and they plan on taxing you more, what do you do to legally minimize your taxes, make more money, and prepare yourself when the dollar collapses so you can have more XRP, so you can have more Bitcoin, have more Ethereum, have more Shiba Inu, have more Solana, more Cardano, whatever you want, and have more productive assets? Well, Number one, you need to like this video, subscribe to the channel, and share this video all over social media so we can help more people understand what's going on so they can prepare. Because here's what I'm personally doing to prepare. And again, take this or leave it. This is not financial advice. Consult your financial advisor if they are a multimillionaire. This is what I've done and what I'm going to continue to do that helped me become a millionaire before 30. Number one, I'm expanding my options. So I'm not just trapped by one small bank. I bank with multiple big banks in case the Fed lets one of these big banks fail, because you know that their goal may be to chokehold the smaller banks to push money into the bigger banks, because when the Fed prints money, who benefits from this? Yes, the dollar goes down, but the big banks benefit from this because they just buy more bonds, they get more money, and money flows back to them. So if they're choking the little banks to put money into the big banks, what do you think their next plan would be to usher in their CBDCs? Would it be to let one of the big banks fail? Maybe it's Wells Fargo. Maybe, I don't think it'd be Chase. Maybe it's HSBC, whatever it is. Next is the Trojan horse to save people, so to speak, which would be their CBDC program. So we don't know which bank will fail next. So what I'm doing is I'm not keeping more than $250,000 in one bank account. And I don't bank with just one bank either to protect myself in case one of the big banks fails, that they could potentially, again, this is a hypothetical. I don't think this is going to happen, but if it does happen, you need to be prepared for the worst. That's why I always say we give you the best on this channel so you can prepare for the worst. That's why number two, I'm holding only enough cash in my banks to basically pay my taxes, run my business, basic necessities, build credit, pay expenses, all that sort of stuff. So when I say things like I'm moving into productive assets with anything extra, right, that's just sitting there, you know, if I'm moving into productive assets, I'm keeping enough money in my bank account to live. I'm not just having a $0 balance, guys. So don't jump to conclusions there. There's multiple nuanced points here. So when there's extra income just sitting on top of itself right there, you got to think of money like manure, right? If you pile it up in one place, it stinks and it rots. But if you spread it around, everything grows. So number three, I'm investing into assets that will either produce passive income or hold value in times of inflation or hyperinflation. And that's where crypto, that's where gold, that's where silver, that's where international real estate comes into play as other countries expand and more people want to move overseas, let alone hire employees overseas. But in order for you to do that, you can't just rely on the income from your job to invest, because the rise of artificial intelligence is replacing workers in industries like healthcare, finance, manufacturing, transportation, retail, education. The list goes on and on and on. You are increasing your risk every single day of being laid off, the days that go by where you don't focus on building a business on the side. So that's what I'm also doing. I'm building a side business. Now, the number one side hustle for you to focus on in 2023, in my opinion, that costs little to no money out of pocket, that's completely recession proof, it's completely depression proof, is an information-based business in any niche that you want, because people are more hungry for information than ever before. Remember, information changes situations. When you have different information, it changes the outcome and the output of your life. You know, education is the biggest problem in the world today. The complete overhaul of the education system and the student loan bubble that's about to burst is next. However, you know, most people that are going through formal education, they need to know that formal education will make you a living, but self-education can make you a fortune. And unfortunately, a formal education is not making people a living because they're having to focus on surviving rather than thriving due to minimum wage staying the same over the past few years and artificial intelligence taking jobs. So if you want to learn the best way to build an information-based business, you can go to bullrunners.com in the description below. You're going to learn how to set up, launch, and scale your own business in less than 24 hours. And you'll also get instant access to our daily newsletter that you can subscribe to with the best information to help you prepare for the worst that's yet to come in this economy. And this information is what helped me become a millionaire before 30. So I know that you are going to love it when you watch the video on the other side. You share this video with a friend as well too, because I know they're going to greatly appreciate you for it as well too, just as you have by watching this information. And when you look at cryptocurrencies and different projects out there, when you have more income on the front end coming in from your information-based business, well then guess what? You don't have to worry about the fluctuations. You don't have to worry about the short-term volatility. See if silver goes up or down, or gold goes up or down, XRP or Bitcoin, or your real estate properties go up or down in the short term. Let's say you're sitting down 10% or 20% if the markets continue to crash. Well, you're still stacking up cash flow on the front end
from your information-based business to where you can just keep more accumulating and dollar cost averaging for the dip. So go ahead, click that link right now in the description of this video. And as always, you know what we're doing. We're backing up our truck all the way to the bank. We're grabbing the bags, packing them and stacking them, leaving no bags left behind because we believe the spending power of the dollar is going down in value. That's the truth based on inflation and what the Federal Reserve is doing. Fed now is not going to fix that. The CBDC system that they're planning on ushering in is not going to fix that. So in order to fix that, you have to take it into your own hands because together, we're all going camping on the beaches of the moon, and Bull Runners Club is going up. So I will see you on the next video. I will see you on bullrunners.com. As always, you know what to do. Stay bullish.